Welcome to this financial habit. In this video we are going to talk about how to prepare for the coming economy in the US. So before starting this video, like this video, and subscribe to Financial Habit for future updates. Because of its size, the US economy is remarkably resilient. Even the most terrible events are exceedingly unlikely to result in a collapse. Because the surprise element is one of the most likely causes of a probable collapse, if the US economy were to collapse, it would happen swiftly. Most people are unable to recognize the warning indications of impending failure. On September 16, 2008, the US economy came close to collapsing. The Reserve Primary Fund broke the buck on that day, when the value of the fund's holdings fell below $1 per share. Money market accounts, where firms hold cash to fuel day-to-day operations, were raided by panicked investors, who withdrew billions. If withdrawals had continued for even a week, and the Federal Reserve and the US government had not intervened to support the financial sector, the entire economy would have come to a standstill. Trucks would have come to a halt, grocery stores would have run out of food, and companies would have had to close. That's how close the US economy came to imploding and how vulnerable it is to a repeat. Is the US economy on the verge of collapsing? It is improbable that the United States economy will collapse. The government has the ability to intervene fast in the event of a total collapse. For example, to combat hyperinflation, the Federal Reserve can utilize its contractionary monetary instruments, or it might collaborate with the Treasury to provide liquidity, as it did during the 2008 financial crisis. Because banks are insured by the Federal Deposit Insurance Corporation, a banking crisis similar to that of the 1930s is unlikely. To counteract an oil embargo, the president can release strategic oil reserves. A cyber danger can be addressed by Homeland Security. A terrorist attack, a transportation disruption, or rioting and civic unrest can all be dealt with by the US military. To put it another way, the federal government has a lot of tools and resources to keep the economy from collapsing. These methods may not be sufficient to defend against the broad and pervasive crises that climate change may bring. According to one analysis, a 4 degrees Celsius increase in world average temperature will cost the US economy 2% of GDP every year by 2080. For comparison, 5% of GDP equals around $1 trillion. The higher the expense, the higher the temperature increases. What happens if the United States economy collapses? If the US economy crashes, you will most likely be unable to obtain credit. Banks would be forced to close. Food, gas, and other needs would be in short supply. Water and power may be unavailable if local governments and utilities are affected by the collapse. Global panic would ensue if the United States economy collapsed. The dollars and treasuries demand would drop. The cost of borrowing would rise. Other currencies, such as the yuan, euro, or even gold, would see a flood of investors. As the dollar's value fell against other currencies, it would cause not only inflation, but hyperinflation. Consider the Great Depression to get a sense of what life was like during a collapse. On Black Thursday, the stock market plummeted. It had dropped by 25% by the following Tuesday. That weekend, several investors lost their whole life savings. 1 out of every 4 people was unemployed by 1932. Wages for those who remained employed plummeted. Manufacturing wages fell by 32% from 1929 to 1932. The gross domestic output of the United States was nearly halved. Thousands of unemployed farmers and other laborers relocated to California and other states in search of work. 2.5 million people fled the Dust Bowl states in the Midwest. It took until 1954 for the Dow Jones Industrial Average to return to its pre-crash level. Crisis versus collapse. A financial crisis is not the same as a financial meltdown. The 2008 financial crisis was not a collapse, as devastating as it was. Despite the fact that millions of people lost their jobs and homes, basic services continued to be supplied. Other financial crises in the past appeared to be catastrophic at the time, but are now largely forgotten. Stagflation in the 1970s. Double-digit inflation resulted from the OPEC oil embargo and President Richard Nixon's decision to abandon the gold system. To combat inflation, the government responded to the economic downturn by freezing wages and labor rates. As a result, there is a high rate of unemployment. Businesses couldn't afford to keep workers at unprofitable wage rates because of the low pricing. Recession of 1981. The Federal Reserve hiked interest rates in an attempt to bring double-digit inflation to a halt. This resulted in the greatest economic downturn since the Great Depression. To put an end to it, President Ronald Reagan slashed taxes and expanded government expenditure. The savings and loan crisis of 1989. Thousands of banks have closed as a result of bad real estate investments. Charles Keating and other savings and loan bankers had misappropriated monies from bank depositors. The subsequent recession resulted in a 7.5% unemployment rate. The government was compelled to spend $124 billion to bail out several banks. The Great Recession of post-9/11. The terrorist attacks on September 11, 2001, created widespread fear and extended the 2001 recession, which saw unemployment rise to more than 10% through 2003. The reaction of the United States, the war on terror, has cost the country $6.4 trillion and counting. The financial crisis of 2008. In 2006, rapidly decreasing property prices and rising mortgage defaults were early warning indicators of the 2008 financial crisis. 16 If left unattended, the subprime mortgage crisis, which scared investors and resulted in enormous bank withdrawals, spread like wildfire throughout the financial community. The United States government had no choice but to bail out too big to fail banks and insurance corporations like Bear Stearns and AIG, or risk national and global financial disasters. It's too early to estimate the entire expenses of the global health crisis in 2020. The pandemic of the coronavirus is still ongoing. Global supply chain disruptions, increased volatility and steep losses in financial markets, and dramatic slowdowns in the transport and hotel industries have already occurred. How much should the economic cost be? The worldwide economic damage, according to the United Nations Conference on Trade and Development, may lower global growth rates to 0.5% and cost the world economy up to $2 trillion by 2020. What should you do to prepare for the coming recession? Companies that do not evolve now, according to John Friedman, will face a difficult future or none at all. John N. Friedman is a professor of economics and international and public affairs at Brown University, as well as a founding co-director of Harvard University's Opportunity Insights, which has been tracking COVID-19's effects on the U.S. economy in real time. He made economic projections in Inc.'s special report on the future of business. According to Vickian, your team uncovered information about the economy's impact as a result of the pandemic. Some experts, including you, believe we're in for a worse economic downturn than the financial crisis of 2008-09. What do you mean by that? This recession has been unlike any other in recent memory. It had such a strong initial impression. Consumers from high-income households had a strong reaction to the pandemic. They were the ones that cut back the most on their expenditure. Local small enterprises in affluent neighborhoods were particularly hard hit. What caused that to happen? It's difficult to know without seeing into people's minds. However, more than half of the expenditure reduction during the pandemic was attributed to the top quarter of the wealthiest households. What are the ramifications? In the United States, earnings have grown far faster at the top than at the bottom over the last 40 years. In recent years, we've begun to see signs of more balanced growth, with median wages beginning to rise. However, the pandemic came to an abrupt end. There are now millions upon millions of unemployed people. The reality of such a high unemployment rate will eventually catch up with the broader economy, sooner or later. What is your forecast for the future of our economy as a whole? I'm optimistic that everything will return to normal once the pandemic has passed. But it's on the small business side that I'm most concerned. This is due to the fact that these companies have the smallest cash reserves. My impression is that many small firms will close in the coming year. However, new small enterprises may emerge, as well as a slew of fresh entrepreneurial activity and new, exciting things for people to discover. What is your finest piece of advice for entrepreneurs? The businesses that are the most adaptable and innovative will recover the most quickly. These companies must develop innovative ways to deliver their core, while remaining true to their core competencies. Perhaps there is a little different form of service that relies on the same core business principles but evolves with the times. Small businesses are ideally positioned to shift focus in this way, since they are more nimble and adaptable in reaction. What do you think about this video? Do let us know down in the comment section below. If you enjoyed this video and want to hear from us again, be sure to hit that subscribe button before you go.